Thank you, Brett, and I must congratulate SAP Concur for organizing this thoughtful virtual event. Over the last few decades, the global economy has evolved at a rapid pace. To sustain the same momentum and grow exponentially at speed, we must move towards adapting advanced and convenient methods of functioning. Corporates with high growth plans realize the value of digitalization and the right methods of cost control. Once the current situation improves, we look forward to emerging stronger and serving as a springboard for the revival of business sentiments. Yet, at the same time, economic pressures will force us to focus on trimming cost, releasing trapped liquidity, and tightening working capital in order to boost profitability. More than before, it is now we feel a stronger need to connect with all of you and share how a new emerging trend of commercial card usage as a preferred payment method will help you overcome these challenges. HDFC Bank, on its commercial card platform, annually processes 50,000 crores of direct and indirect expenses for over 20,000 corporates and a million plus SMEs. Our aim is to provide our current and future clients with a broad range of perspectives and thoughtful analysis of emerging best practices, which we see as adding measurable value to them, and perhaps more importantly, to provide collection of viewpoints that puts these trends into a broader and more strategic context. Our clients operating across length and breadth of India have often shared two common challenges which significantly impact their use of payment methods and of their vendors. First, initiatives to increase working capital by extending DPO, days payable outstanding, and at the same time meeting suppliers' need. Secondly, improving rates of straight-through reconciliation in account receivables and help reduce DSOs, daily sales outstanding. Over the next 5 minutes, we will briefly discuss how a new trend of commercial card usage as a preferred payment method will help you address these. With case in point, first on account payable. Almost all of our clients unanimously revealed that there is a significant improvement needed in managing direct and, more importantly, indirect expenses, especially in those where automation of the payment process is limited and its integration with the ERP system had not happened. Reluctance to change may have arisen due to its centralization of account payable process, with staff dedicated full time to the task of processing payments. As a result, there may have been limited consideration of alternatives. That being said, there is always a focus on increasing their DPOs wherever possible. DPOs varied greatly between the companies and vendors, with a range between 7 days to 120 days. However, the average appeared to be 30 to 45 days, which is where a commercial card solution rightly fits in. Every company, and more so in current times, is looking to build platforms that can bring together every source, every category of vendor payment and getting a unified view. Instead of managing travel and entertainment expenses, decentralized business expenses, and supplier payments in separate silos with separate systems. Given that travel and entertainment expenses can account for a significant proportion of a company's budget, it is not surprising that many companies in India are now shunning papers or spreadsheets based expense management system for the automation with underlying payment methods like corporate cards. Besides convenience on payments, companies also welcome the greater control over employees' expenses and the relief from handling petty cash. Thus, we at HDFC Bank joined forces with SAP Concur, the world's leading brand in travel and expense management, to bring our corporate customers the most comprehensive business payment and spend management solution. This will be a very effective tool for the organization in managing and controlling travel and entertainment related expense. reducing cash advances and providing travelers with an easy, fast and safe method of capturing spends and payments. The organizations can also integrate card transaction data into internal MISs, expense reporting and account payable, and simultaneously benefit from credit it offers in extending DPO. Similarly, on vendor payments, our collective experience with our clients has been that most of them have more suppliers than their employees. 80% of the order value is from 20% of the large suppliers, where they have a negotiated terms for procurement. However, the biggest challenge for them is to manage these 80% of the suppliers that are high on volume and low on value, and are often decentralized in nature. Often an organization spends a lot of time, rightly so, focusing on large suppliers, reviewing them and negotiating multiple times. The actual problem starts after a few years when the tangibility of saving from these vendors dries up. Hence, companies are looking to find newer ways and automating, integrating all these small vendors onto a platform with the underlying payment method of purchase card that can provide them data of all suppliers, which then can be leveraged on pooling all the small spends into a fund with a fewer suppliers. Increasing leverage on the pricing that can potentially offer 20 to 30% of saving on unmanaged, non-negotiated, maybe one-time expenses, and also at the same time benefit from credit it offers in extending DPOs. Secondly and final, account receivables. This is relatively a new trend evolving in India, as more and more corporates have started enabling acceptance of commercial card towards their payment receivables. Our interaction with clients revealed the need of straight-through reconciliation that influenced acceptance of commercial cards, and additionally helping vendors get favorable credit terms on commercial cards. While rate of financial reconciliation, which focuses on net credit and debit movements across the accounts from bank statements, is high, the biggest challenge for the corporates have been operational reconciliation of collection generated by order to cash cycle of the business. It was reported that auto reconciliation rates in this category ranged from 15% to 30%, which then requires significant manual intervention to complete the task. For the majority of our clients, 90% of the payments they receive are made by direct deposits. However, with direct entry, the remitter behavior is key, and companies which look to improve straight-through reconciliation have to invest in educating their remitters on what information and references should accompany payments. Additionally, clients have also highlighted that often vendors send partial payments or pay on account periodically rather than paying against each individual invoices. This leads to additional time and effort spent reconciling a single payment against multiple invoices, as automatically matching against invoice amounts in these cases is typically not possible and therefore requires manual intervention. Our clients are continuously engaging with us to address these concerns through acceptance of purchase cards that offers high rate of operational reconciliation. Payments can be triggered against each invoice with unlimited data field to capture all the information and references accompanying payments to improve accuracy of data. Hence, to conclude the session, a new trend on usage of commercial cards for B2B payments is not only improving straight-through reconciliation rates, but will also yield process efficiencies. At the same time, helping business manage working capital through extended DPOs with improved terms to their suppliers and reducing DSOs with freeing up vendors' credit lines. Thank you so much for your time today. It has been my pleasure to be a part of this session. I would now like to invite Venkata Subramaniam Srinivasan, Director, Value Management at SAP Ariba. He will be presenting on opportunities for CFOs to plug cost leakage and create value. Over to you, Venkat.